Hi everyone, welcome to Quantsapp and welcome back to yet another video. In this video, we will learn about some volatile strategies out there in the market, which you should typically start to observe when there is a big event lined up in the market. Okay, the event can be anything. It can be a budget. It can be as simple as a stock result. It can be a corporate announcement, a credit policy announcement, whatever. Okay, so whichever news which would affect the market straight away is an event for us, and how do we go ahead and trade these events is something what we will learn in today's video. So we will learn 2 or 3 strategies, but the idea of understanding these strategies right now is because the result season is underway. A lot of stocks are going to announce the results. If I just show you the stocks name which are going to announce their results. So you can just check this out in result calendar in our application. So you can see today as I am recording this video on 1st of Feb, and the budget is also getting announced. So IDFC, Tata Chemicals in copper, Jubilant Food, Whirlpool, Britannia and Ashok Leyland. These are the stocks which are going to announce their results today. So now how we go ahead and trade such type of events in the market. Now when we talk about options, so the beauty is such that even if you don't have a lot of forecasting power, still options as an instrument are capable of generating more returns from that that particular view as well. Now let me make it simple what I'm trying to say. So let's say there is budget getting announced, but I know if this news comes, then Bank Nifty might move, let's say, up by 1,000 points. And if this news doesn't come, the news might be anything, okay? But if this news doesn't come out, or if this news isn't published, Bank Nifty might drop down 1,000 points negative, okay? But can I go ahead and create this trade using futures or using the underlying? The answer is no. You can't go ahead and buy and sell the futures at the same time. But options, there are 2 types of options: call option and put option. By combination of these, we can go ahead and easily create or trade such views. Okay, and similarly with the stocks as well. If you know that, okay, if the stock announces this much profit, if the stock beats its estimate, okay, it is going to go up, or if it does not beat the estimate, it is going to go down. But till the result is announced, you don't know anything, right? So how can you go ahead and play around with such views? So that is something what we will learn in the today's video. Okay, so before I move towards the strategy, one more thing I want to show you all is, which is there is one component in an option premium that affects the option, which is known as implied volatility. Okay, so what is implied volatility? Implied volatility is nothing but expected volatility. The volatility expected by the traders in the market to play out in the coming time is shown to us by implied volatility. How it is calculated? It is calculated using the option premiums. But markets are self-efficient that they will go ahead and calculate the implied volatility for you. You don't need to go ahead and do it anything. In our option chain tool, which I'll show you in a while, that tool will show you implied volatility for all the strike prices and all the options available. So now what I'm trying to say is that, let's say a budget is going to get announced. So before the budget, every trader who is trading in options, he would be very very uncertain कि budget में क्या होने वाला है, what is going to be the outcome, right? Till the budget day, everybody is going to be uncertain because nobody knows anything. But the moment the budget is announced, everybody will know that, okay, there were positive news related to this sector, there was negative news related to that sector. But one thing that will happen is the uncertainty will diminish, right? So implied volatility also will behave in the same way, which means that before the budget or before any major event, not specifically budget, it can be results as well, but before any major event, the implied volatility, it will keep on going, okay, up. And the moment that uncertainty becomes known, let's say on this day the budget is going to get announced, okay, so before the budget, the implied volatility will keep on going in the upwards direction. And the moment the budgets are out, not maybe not from that very point itself, but one or 2 days here and there is okay, but the idea is that the moment that uncertainty becomes known, okay, likely is the chance that implied volatility will collapse. Okay, now what happens during this is when the IVs are going up, so they options, okay, our options, they hold this value of the budget or any news which is coming up, right? which is called as the time value of money, the price of implied volatility in the option. So when the IVs are going up, regardless of everything in the market remaining constant, the call option will go up and also the put option will go up, right? That means if the IVs are going up, then even if market remains exactly where it is, time remains exactly where it is, but still our call and put option premium will go up. Why? Because the IV of that stock, it is going up, or that option is going up. Okay. And moment the uncertainty is done, what will happen is the implied volatility will collapse. Okay, so just a simple thing I'll try to show you all today, what happened actually today, by showing you, let's say, India VIX. Now, yeah, elsewhere, let's first understand about IVs itself. So let's say IV chart. Okay, so this is Bank Nifty's IV. So the orange line is showing us the implied volatility and of Bank Nifty on day basis, what implied volatility was, and the green line is showing us the futures price of Bank Nifty. Okay, so now just check. Okay, so this was 30th of Jan. Okay, where was implied volatility for Bank Nifty? It was 22.37. The next day, which is yesterday, it collapsed a bit, but marginally, not heavily is what we can call it. But today, what happened is the budget is out, the uncertainty has decreased. What happened is, see, from 22.37 implied volatility, it collapsed all the way to 22 to 18.58, right? Why is that happening? That's happening because the uncertainty in the market, which was the budget, it is becoming known, right? So just see, before the budget, the IVs of Bank Nifty, it kept on moving up higher. And the moment the budget was out, or the when we came on the day of the budget, what happened is the implied volatility, it collapsed. So what would have happened is the premiums in this zone, okay, this in this entire zone, the premiums would have kept on getting costlier, right? Regardless of how Bank Nifty moves, the premiums, it would have kept on getting costlier. But right now, what would have been happening is the premium value will decay, okay, because of the collapse in implied volatility, because of the fall in implied volatility. I will show you that as well. So, but just look, check this out. So this is TCS. See, the dots are showing you result, which is a major event. See, the IVs kept on going up. The moment the results are out, the IVs collapse. IVs kept on going up. The moment the event is out, the IVs collapse. See, that is something which is happening. Okay. Now I will just show you one last thing, and then we will move towards the strategy part, that what are the strategies we can do. See, so this is TCS. Let me just bring Bank Nifty. Okay, so just check this out. Okay, so Bank Nifty right now is trading at 41,290, 41,300 straddle. Okay, and by the way, Bank Nifty is today up by 0.8 to 1% when I'm recording this video. But the thing is, despite Bank Nifty is up so much, right? The call premium, it is just up by 58 rupees, 58, 55 rupees roughly, right? It is just up by 50 rupees. But how much the put premium has collapsed? The put premium has collapsed by 350 points, right? If call, when the call option is going up, right, and if the Bank Nifty has went up, the call option will naturally go up, right? And it is what has happened. But the thing is, if you just see how much the put option premium has collapsed, 370 points, right? And if you talk about the combined call and put premium, it has collapsed by 300 points. Why is that happening? One simple reason: average IV, right? Implied volatility has dropped by 5.8 percentage today. That is the reason when you're trading in options, you should never ignore the component of implied volatility. See, if someone had a bullish view, he would have made money, right? He would have made some money, but not very much enough. Yes, if he would have if he has a bullish view, and if he would have sold a put option, then it would have been more lucrative versus just buying a call option, because the implied volatility is going to collapse. So to conclude, what we learned till now: first thing, before any major event, okay, the IVs will keep on going up and the premiums will keep on going up. The moment that uncertainty becomes known, the premiums might collapse and the IVs might collapse. Okay, so before any major event, let's say you don't know where what the budget is going to be, what is going to get announced, and what a stock result is going to be. So in such type of instances, what you can do is you can buy a at the money call option, and you can buy a at the money put option. What this is a long straddle. What does that tell you? That tells you that if market goes anywhere, still you will end up making profit. Now you see on what levels how much profit or loss you would make in this particular strategy as a whole. First benefit, right? This is typically you will do before any major event. I'll tell you why. First thing is you are getting benefit of direction. Second thing is this strategy is a vega positive strategy. That means if the IVs go up, right, the strategy will benefit you more. Reason being because it is vega positive, you have bought your long on both the option, right? So over here, if see, if the IVs go up by 20%, still that this strategy would make you lucrative returns almost everywhere, right? If market remains exactly where it is, then you will make a small loss, very small loss of 550 rupees. Okay. So this is long straddle, and this is typically before any major event when you are expecting the IVs to go up. Okay. Then one more thing is what you can do is, so apart from this, so this is something which you don't have any forecast on the instrument, right? You don't know what is going to happen. But let's say you know that the market or the stock what you are trading, whatever it can be, the instrument can be anything. But let's say you are slightly bullish on the instrument, right? You feel that you have more bias on the positive side of that stock. So how will you trade it? Okay. So if you buy only a call option, the problem with that is if your view goes wrong, you're going to get out of the trade immediately. You will neither get any vega ka benefit, neither get any IV ka benefit. You will be stopped out immediately. So what you can do is you can buy two lots of call option, and on front of that you will just buy one lot of put option. Okay, so this strategy is called as trap. Okay, so again everything remaining the same. This type of strategies you will do majority of the time before any major event when the IVs are getting spiked up, when the IVs are shooting. Benefit: market goes either negative, still you are in profit. Market goes positive, you are still in profit. IVs going up is something what you would like in this strategy because it is again a vega positive strategy. You have bought, you know, three lots, basically one, two of call and one of put. So it becomes, IVs become beneficial for you. Only problem in this strategy is theta. Don't hold this strategy for a lot of time. Don't hold this strategy for 10-15 days. It will not be a lot of help for you. Maximum in monthly option 2 to 3 days is something what you can try to hold. For weekly options maximum 1 or 2 days. Okay, so this is from the strap side. This is when you will do, where you will do this when you are expecting us, when you have a slightly positive bias on the instrument. Okay, another type of strategy is, now let's say if you have a negative kind of bias, what you can do is you will buy two lots of put. Okay, double the quantity of what you have bought. Okay, add legs, and you will buy just one call option. Again same scenario repeats, right? The strategy is same, only in this case your bias is negative, right? And this strategy is called as strip. So yes, folks, that was it from my side for this video. But before summarizing the entire video, I would like to invite all of you to India's largest option trading conference, Option Symposium 5.0, wherein you will learn to trade options better using 10 plus strategies, which are going to be explained by the industry veterans who have successfully managed huge wealth in options trading these type of strategies. So the link would be in the I button over here. You can pop it up. Okay, maybe here or somewhere you can pop it up, and you can check out the entire details. So there are very few days left to the option symposium, so do check out the details as soon as possible. And I would really appreciate if you come and join us at the option symposium, because you'll learn a lot of strategies. And even if you just equip yourself with two or three strategies which are going to be explained by the veterans themselves, so that is going to be a great help for yourself as well. So do check out the details out here. And apart from that, whatever we learned today, it was more on the IV's front and before the result, right? For post resulting, how we will do it is something we will record another video on that. So stay tuned along with us. Bye bye, take care, and happy trading to all of you.